Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, February 20th, 2019. In this video, we'll take a quick look at some of the major asset classes. We'll start out with the equity markets. Definitely want to look at gold, seen some movement there lately, and we'll touch on crude oil, natural gas, and time permitting, maybe I'll touch on treasuries real quick as well. That'll pretty much be not all inclusive, but close to it. All right, so this is the 60-minute chart here of QQQ. We're starting out with same really no developments to make mention lately. We continue to really wedge tightly. You can see this price compression here. If you recall, in the last couple updates that I've done, for a while there, I was really focusing on this uptrend line off the December 24th lows, and I'm sure a lot of people are, so I'm sure they're significant. But then you also have this one here with more reactions coming off that first reaction low on the December 27th. So keep an eye on that. So we at that point you have intersecting trend lines, and chances are that those traders that aren't watching this one or this one are watching the other one. So it should certainly give us some movement if and when those break. In other words, the next sell signal. Right now we're wedging up, and remember we do have the divergence, but that's not a sell signal, and we could certainly continue up. This is just a divergence line. The trend lines I do change if there are enough reactions and a reason to change those, but those are usually that's what we're watching for sell signals. Divergence lines are not trend lines per se; they're dynamic. So if we continue to push on up, as long as we keep these divergences intact, we'll just move these lines up a little bit and then wait for again the sell signal. Because as I often say, divergences in themselves are not a buy or a sell signal, merely an indication that an impending trend change is likely. So that's what we're waiting for. And when you get this tight price compression like this, if you get a sell signal, what will usually happen is you'll wipe out weeks of gains in just a matter of days. And that would probably be the case here if they all go together. And let's get to the rest of those. When I say those, I'm referring to the other, particularly the two big large cap indexes, QQQ and SPY. You can track the Dow if you want to, or any other indexes. But when these two break, you get sell signals on both. That's a pretty good chance that the markets will be heading lower. So you have this same story here. You have SPY continuing to diverge, just working its way up. You had divergence at this point, a little pullback. You had divergence here, and you haven't yet taken out. So we have really three trend lines on SPY to watch, and you can see them all here. I have this blue trend line, which forms a parallel price channel right now with the divergence line there. So that would be. You can look at it this way. You have the two trend lines that I just covered on QQQ, the one off the 27th of December and the one off the 24th reaction low. They come in close, but not as close as the other two. So there's really a confluence of support there that needs to be taken out. And, if this market's taught us anything in the last month or two, it's give the benefit of the doubt to this trend or the previous trend. This trend is no different to that previous trend back there. On the downside, it was just as resilient to the downside, and that's just the character of this market. Everybody's on one side of the boat, and then they quickly flip to the other side. They haven't done that yet. So there's your trend line number one, trend line number two. Now, what I like here, and a couple points I want to mention. I usually, if I have more than one trend line that I think is valid on a stock index, then I will give the benefit of the doubt to the lowest of the two in a case of an uptrend, that is. So this is my BOD, benefit of the doubt trend line right here. In other words, these two can get broken, but you still have a pretty decent trend line here. Not as long term as those other ones, but you also have 273 support, and you can see that was a reaction high there. We broke above it, came in successfully back tested it, and moved up. So if we come back in, you have a couple trend lines there that might trigger the selling, and it could certainly be the catalyst to smash right through this. But if not, you have support right here, which undoubtedly some traders are watching, and so you may have the buyer step in there at 273 and or this uptrend line. So to be safe on SPY, you want to see that trend line go. And the more it's taken out with conviction, in other words, impulsive, high volume, everything you want to see, the better the chances that breakdown will stick. And as you can see here, I've already covered these in recent videos. Those are some additional targets. IWM, talk on that real quick. Same story, really. Nothing has changed. The markets are just inching higher. The momentum, the markets are moving up, but the momentum has clearly waned. I went over that the other day in the recent videos. From the lows on the 24th to this point here, January 18th, the IWM rallied, about 18%. And since then, that was the bulk of the gains so far. And you can see the same thing on SPY and QQQ and everything else. That's where the bulk of the rally happened. And we've been moving higher. There's no arguing that since then. But the slope of the ascent, if you will, has tapered off. And here it is on QQQ. And of course, remember that that's what divergences and momentum indicators tell us. They speak to the momentum in the market, and they show you that waning momentum, especially when you get those divergent highs. You have a pullback, then another thrust up. That's usually a sign of an impending trend change. So we'll wait for that, and let's look at the futures, because that's really, I think, will give you a heads up. I like to watch all the futures as well as the major index tracking ETFs. So here's ES, and again, I've covered it recently, so I'm not going to spend too much time on it. There's that trend line off the 27th lows. Quite a few reactions so far. Need to see that one go. And then on QQ or NQ. On NQ, even better. I mean, this one's really, really compressing. And there's that trend line off the 27th lows. Lots of reactions so far. Reaction there, reaction, 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 reactions. A lot of reactions. So it's just hugging this trend line. And again, you do have pretty steep divergences here. So if NQ wants to make a pop, it can certainly do so. But let's watch a couple things. Let's watch this PPO to see if we can get a solid cross down below the zero line. And of course, most importantly, sell signals with breakdowns on all those trend lines on the futures and indexes. And until then, this is what the market's doing. And if you missed it the other day, and I'll get to this on crude in a second, I drew these two trend lines, just measured. I took the lows on the 24th of December, that Christmas Eve low, and that rally that was January 18th, was over 17%. So NQ, the NASDAQ 100 futures, rallied 17% just in the first few weeks off the bottom. And then since that point back on the 18th, have climbed less than 4%. So although the market won't go down, and it is going up or has gone up since that point, it's hardly going up. It's been mostly a sideways to slightly upwards grind. So again, and I was saying it back here, the risk reward to the on longs and to the upside is just not attractive, and hasn't been for weeks now, despite the fact we've gone up. And I maintain that right now. Again, risk reward is you're risking in other words, do you think the next 10% will be to the upside before the downside? If you do, then you go long, although you really want to try to time your entries. That's what technical analysis and swing trading is all about. Even if you're investing or trend trading at this point, I think most would agree that it's prudent to wait for a pullback if you are looking for a move to new highs, and that's something you can take, from my analysis or anyone else's, whether you agree with how far we're going. I can certainly list some good levels and tell you where, which key levels are, which I'm highlighting right here, that are likely to come into play on a pullback. And then that's your decision. Whereas I'll be looking for a move down, at least down to the 66.32 level on NQ. Following a sell signal here. Others might want to buy a pullback, and there I can tell you there's certainly nice support there, about 68.57. So if you want to buy a dip, you buy it there, and maybe with a stop somewhat below, or you take a partial position there, and then you add your second lot there if you think the market's going to go on to new highs after that. Small cap futures. This is the RTY, the Russell 2000 futures. There you could draw a couple trend lines. I don't have any solid trend lines on this one, but it does appear to me to be moving up in a price channel, as you can see, defined by starting with this reaction. Quite a few reactions there. So here's your lower trend line. For the most part, this is the upper trend line, and once in a while you'll have a security pop above a channel, and then it'll set up a new parallel line. And that's what you can see there. So the way this works usually is once you have these lines, sometimes it's the midpoint line I can draw on a channel, but this one has quite a few reactions. So my guess is a break there would bring RTY, or the small cap futures, down to that uh, uppermost or lower trend line, the bottom of the channel. You can see potential divergences, not confirmed. You can see the PPO is pointing higher. Oops, I tried to box tool it there, but you can see right there, PPO is pointing higher, or MACD in this case. And you need to have that turned down to confirm the divergence. So there's futures on small caps. And since I'm using the different charting program, just to clean, this is going back to the NQ NASDAQ 100 futures. There's that trend line off the lows there. Just a nice, clean looking wedge. And I think we have something similar with, there it is, with the ES futures. There it is, that trend line, lots of reactions. And I haven't updated this yet, but you can see the divergences are starting to steepen here, or fall off. So we call that double negative divergence or consecutive divergences. You had divergence there, and now it's starting to steepen down there. That does one of two things. It allows for a pop-up to keep the primary divergences intact, or sometimes those sharper divergences at the end will trigger the trend reversal. And again, you need to see the breakdown there. Okay, now onto something that actually is moving at a pretty good clip the last few days, gold. This is GLD, the daily chart. And, I had mentioned before, there are potential divergences not confirmed. You have the PPO right now, poised, just made a bullish cross up. Gold broke above this level here. It's still above this uptrend line, so it's really in this parallel price channel here. But this is a pretty impulsive breakout yesterday and follow through today. And then more importantly, well, no, let's stick with gold, and then I'll get to GDX here in a second. More importantly is this long-term big symmetrical triangle pattern. I've been harping on this one for many, many months, going back to last year at least. We have a pretty impulsive breakout now, and that's longer-term bullish, and I've not wavered on my longer-term bullish outlook in gold. We'll do one of two things at this point. It's either going to come on up here to my next target about 130, or it may come back in, and I have to zoom down to the intraday charts in a second here, get a back test, and that would offer the next objective long entry for gold. But either way, so try to quantify it for you until gold really hits resistance, because I may be adding this one back as a long-term trade again. Only about 2% upside left on gold or GLD before it hits some pretty significant resistance. So that's one reason that I'm holding off. We had a long trade that we closed out recently, not too far below current levels before the breakout. So we might get something like this if it heads up there, and that might be our chance to reload. And or if we don't even get that and we break out above 130, maybe a back test of 130. So there's a lot of possibilities here, but I just want to reiterate, longer term investors, don't worry about this short-term stuff. Gold looks good for now. The dollar confirms, bearish dollar outlook, and this breakout only helps the bullish case for gold. But again, this is a big level, this 130, because although I believe gold bottomed back here in late 2015 and started a new bull market, you really can't say that looking at the charts because it's been more of a sideways trend. Upwards to sideways. We're making higher lows, which is one part of an uptrend. An uptrend is defined as a security making a series of higher lows and higher highs, and that we don't have right now. We have equal highs. So really, that just gives us, if you want to look at it this way, a big old, what they call ascending triangle pattern somewhat. It's not really a perfect, we don't have a lot of tags there, but I can say that 130 level is a pretty important level. There's, some reactions going back for years on GLD there. And the miners just continue, like I said, they've already broken out and haven't looked back at that symmetrical triangle pattern, big impulsive move after the breakout there. We could probably put that trend line right about there, give or take, close enough. It's a weekly chart. So that looks good. And remember, the GDX will follow gold. It moves up higher in percentage terms, but for this chart to continue to play out, you're going to have to see gold continue to firm up the bullish case there. On the last update on GLD and GDX on the precious metals, I highlighted this potential bull flag pattern, and that's what it proved to be. This is a flagpole. You can look those up. These are great patterns to trade. They're continuation patterns. You have an impulsive move. That's signature number one. An impulsive move leading up to formation of a bull flag, then an impulsive breakout, and an impulsive move. And typically, the move leading up to the flag is the move out of the flag matches what was leading up to the flag. In fact, that's the measured target if you take that measured move. So, that would project all the way up here. Somebody asked today, is a reversal in GDX imminent? They're in Nugget. It'll come. Right now, there's really nothing in the charts, that I see to say it's coming right away. Certainly possible. Anything's possible, but I just don't see a lot of glaring evidence to get out. We do have potential divergence right now on the 60-minute chart of GDX. Potential. Again, I harp on those terms. It's something I use. It's not in the textbooks. I think a lot of people get confused because technically you have negative divergence when prices are making a higher high and your indicators are making equal or lower highs. So this is technically speaking negative divergence. However, you have the momentum indicators clearly pointing up. And as long as they're up and the momentum's up, you can take out that previous high. So, in my book, I like to say it's confirmed once that PPO or MACD, if you're using, makes a bearish crossover and effectively puts in a lower high like it did right here, because you had a peak and then the crossover, so that confirmed that peak. And there was your confirmed divergence right there. And then you can see a correction in GDX. So that's something to watch for. But if we go up much more, that divergence will be taken out. And again, short-term, long-term, you got to define your time horizon. Long-term investor, everything just continues to firm up. The longer-term outlook for gold, everything we've seen recently in GDX. So you don't get overly concerned in 60-minute charts and even the daily charts. Just watch those weekly charts, and they'll keep you in the trade. Okay, next up, crude oil. This is CL Crude Futures. Here's a trend line right now to watch. 3 reactions so far, so we'll keep an eye on this one. 1, 2, 3. And also right there about the $56 level. That line's at 56.05. We'll call it 56. You have a little shelf of support, which was actually also the breakout above that previous reaction high. Bigger picture on crude, it traded, I forget, I did the numbers in the trading room today for somebody. I think this is almost about a 30% gain off the lows. So most of the rally, a lot like the stock market, happened right up until about January 18th. And then you can see that crude has been locked in a mostly sideways trading range since then, making, slightly higher high now. So we have a higher high. It is a divergent high. No sell signals yet. So watch that 56 level, because if that gets taken out, it'll also have taken out this uptrend line. So there's 2 intersecting support levels. Other than that, the trend is up for now, but I want to show you something on USO, the long-term chart here. So let me pull that chart over here, USO. Well, I'll make mention, and USO tracks well. Some commodity ETNs do a lousy job. The nat gas ETNs are notorious. That's why we had a stop clipped on that D-gas or U-gas recently. But the N-gas trade still looks great. That's never seated with the same comparable stop. NG I'm referring to, I should say, the futures. I'll get to that also in a second here. But on USO, you can see potential but unconfirmed divergence. You can zoom in, you see the PPO is pointed higher right now. We don't have the divergence on the R side, but it's not really this daily chart. I wouldn't take a lot from what I'm seeing here. The big takeaways are these divergent highs. This is when you want to swing crude oil. When you have a divergent high on both the PPO and the RSI on this daily time frame, it's hard to argue that these just didn't lead to these sell signals. And of course, there's trend lines that tell you when to go in. The trend lines say, you'd have to zoom down on a 60-minute chart to see this one. But you have those daily divergent highs, and those were the big, double-digit percentage gainers. I believe all those pullbacks are well in excess of 10%. And of course, this was the moneymaker right here. Big divergent high, 3 consecutives, usually that third strike and you're out, and that set the move for that big move down. And then, as pointed out at the time, strong bullish divergences leading into the lows, and that's been the catalyst for this rally so far. However, let's not ever take our eyes off the bigger picture. This is a weekly chart of USO. Tells the long-term picture. Crude oil, after the vicious bear market that plunged down and starting in 2014 into the 2016 lows, crude based for a couple years in a sideways consolidation period, a basing pattern, and it broke out of that pattern back here, went on up. You can see all the lines. It's behaved very well to the technicals. A very well defined uptrend line, a divergence line, all pointed out at the time. Negative divergence, and boom. Also, as it ran into resistance, 1611, and then boom, fell down, had a sharp correction. So where am I going with this? Well, you can see where we've come today. That 1193 level, I haven't modified that in years. That is the top of this multi-year trading range. So we, after popping above it, we fell back in it, and now we're testing the top of it. Will it come into play again? It's not guaranteed because we already sliced through it like it wasn't there. Normally, what you would have expected is a back test to that level, even though we had a back test right here after the breakout. But coming down to that, you should have seen a back test, but we just had that meltdown type, what I believe to be forced selling, forced liquidation, margin call redemptions, hedge fund and mutual fund redemptions, and that just caused that plunge down there. So did want to point that out, that's a long-term resistance level. Look, we're ticking at 1196 right now. That level's at 1193. So let's see if it comes into play. Trend indicators are still very bearish right now, meaning the PPO is still solidly below the zero line. That usually denotes your bull or bear markets. You don't want to use trend indicators during sideways choppy trading. They just don't work. They will get you chopped to pieces. You want to use them during trending markets. And you can see right here, when that PPO signal line, the 9 EMA crossed above the zero line. We did have a little whipsaw there. Nothing's perfect. I'll point that out. But there, it gave us a buy signal, and it told you to stay long crude up until, well, didn't catch out in time. But again, this was pointed out on the site at the time that was long-term resistance, negative divergence, and everything else. So that's why you don't rely on these trend indicators, but they'll show you what, you don't use them, I should say, is entry and exit points. They're just to confirm an existing trend or try to help you identify the larger trend, and they are not, especially on the weekly time frame, they are not buy and sell triggers. Okay, and on to natural gas. This is a daily chart of NG, nat gas futures. This is the same chart. It was first posted in the trading room, and then right shortly after, I believe the next day, we put on the UGAS trade. And, I mentioned that the difficulties with UGAS because of the decay and the 3-time leverage and the fact they just don't track well. Of all the commodity ETNs, the natural gas ETNs are probably the worst. They suffer from contango and of course the leverage comes into play. But UGAS is one of the better tracking ones out there. That's the problem. What was it? I used to trade years back UNG, and it's just does an awful job of tracking. It's not leveraged, but doesn't do a good job. And I think GAZZ is another one, gas. But either way, this is the basis for that trade. This chart goes back many years. You can see down here the year marks. This is 2015. I don't know if it's cut off in the video, but where that arrow is 2015, 2016, 27. So there's the year hashes. So we have support on nat gas futures back here all the way in 2015. That support was broken, and we didn't just limp on through there. We had a sharp move down that confirmed it as a valid level, kicked back to that level, had a rejection. That's additional. These are all validations of that support level. Then we regained it. Okay, that's bullish, right? Yes, because we came in and back tested it successfully. Back tested it. That's support. And we're to it again. There is nothing 100% in trading, and support, just like records, are meant to be broken, and just like resistance, it will be broken at some point. But this looks like a pretty objective entry. We had, again, on this daily chart, a fall down to support, strong bullish divergences in place. I said at the time, seasonality is not to our favor right now. Nat gas, you want to usually have a big spike in the fall, around winter. Sometimes that spike comes late, early in January or so. That's usually when you get your spikes, and of course demand falls off for natural gas for as a heating proxy, heating fuel. But again, from a technical perspective, it couldn't look much better. And then we zoom down to the 60-minute chart. Let me show you the other one I have on Interactive Brokers. Okay, this is Interactive Brokers, and this is the one I believe I used for the official trade, showing you the nat gas future. So we had a breakout. You know, the setup was posted in the trading room before the breakout, then we broke out the next day. It was impulsive. Everything you like to see went up. That was my, well, we'll call it first target, first resistance level, and we gapped above it. That was bullish, and it hit the first target of 2704 right there. Pulled back, came in, and essentially just back or tested the previous lows, put in a double bottom, and we've been moving higher since. So the bottom line is we're going to have to take out that 2704 level, or really that previous reaction high. And there is a possibility, and that's what I mentioned. Somebody asked about UGAS. See, unfortunately, with UGAS, because of the 3-time leverage, this is where decay actually hurts you when you start chopping back and forth and trading sideways. I mean, obviously, the worst thing is a position going against you in the opposite direction. The second worst thing, when you have a leverage ETF, especially in a very volatile sector, and that is paramount. SQQQ or what is it? SPXS, the 3-time leverage QQQ or S&P 500 index tracking ETFs, the decay is minimal. And it is so because there's not a lot of back and forth volatility, even when they're in a sideways period. But when you have a security that can regularly move in high single digits and sometimes double digit moves in a single day, and that is the nature of this beast, the decay is absolutely the worst. So that's why, when somebody asks about UGAS, unfortunately, if we get, even if this trade pans out and that gas comes up to where I think it comes up to in the coming months, if it takes a while to get there, a good part of those gains will be lost to the decay. And, that's so. I know not everybody has access to futures, but that's my preferred trading proxy, natural gas. These are Henry Hub contracts, and I think there's a NGAS Mini trades on the NYMEX where you don't need as much capital. NG, I'm looking at another monitor, is $26,640 per contract is what it represents. It's a future contract, so you don't have to put up nearly that much, a small fraction of it, but that's how much of the underlying it represents. So you do the math, a 10% move on that's going to be $2,600, over almost $2,700 per contract. Again, read up on futures if you're not familiar with how they work or how to trade them. And finally, last but not least, we'll cover a good old boring Treasury bonds. They're not get rich quick, but I believe I'm a firm believer in asset allocation, especially in long-term accounts, IRAs, 401ks, those type things, your investment accounts. And, I still like the longer-term outlook of Treasuries right now. This is, let me give you another board. This was our last trade here. This is a trend line I'm watching. So we've pulled back. We've been flirting with this uptrend line. It's not super well defined, but the big levels to watch, of course, that's one, that trend line there. And then you can see right here, that 122.46 level. It's a pretty significant level on this daily chart. You had some consolidation or trading there, and that was support. Support once broken, then becomes resistance. Resistance, more reactions, the more valid that level is. That's one spike, that's an aberration, that's fine. If I have a trend line with 10 or 12 reactions and one little pop through, that's just a false breakout, no big deal. So watch that level. If we break above it, it's bullish. There is divergence. I'm not crazy about that. So those divergence lines right now, basically they're in place, not really confirmed because the MACD or PPO is flattening out. But we have equal highs on price and lower lows there. So price pops up. Just point this out. We're going to have this little wedge type pattern. These divergence lines can be extended. That's near-term stuff. Longer term, I really like the, right now I still like the outlook of Treasuries because this is a weekly chart here. You have this downtrend line that comes off the 2016 highs, this large wedge type pattern. And so you had a breakout here so far. That breakout's held. Breakout back test. And I think we can eventually work our way back up here to that 128.56 level and back test this longer term, more important uptrend line. So if you want to know it this way, I'm intermediate term, near term somewhat neutral, intermediate term bullish, but longer term bearish on Treasuries. because I think when we get there, we come back in. So where this scenario would probably play out, if we get another leg down in the market soon, you'll see a flight to safety into treasuries. TLT should be bid up to about this point. And maybe, again, this is just really getting ahead of ourselves. There's a lot of moving parts that come into this. But if the correction ends and you start to see the flight to safety bid unwind, then that's what you get. Or the other thing is that maybe the market's still going down, but treasury yields are going higher. We all know, you read about it in the paper, the federal deficit is ballooning, and it's not going to get better anytime soon. And sooner or later, investors are going to demand a higher rate for U.S. Treasuries. They're still considered one of the safest investments in the world, but at the end of the day, we're printing our way out of this mess. The U.S. will technically, they'll be defaulting on their Treasuries going forward. What I mean by that, no, not the classic sense that you think of defaulting where you don't make payments. Printing money, debasing your currency, that's another way to default. A lot of banana republic countries are known for doing that. So print more dollars, sell more bonds, pay off the existing ones. And so basically what happens, what does that mean to you? Well, if you've got 100 grand in treasuries, and then over the next 10 years, the value of the dollar drops 40% against other currencies. Well, you're going to get your 100 grand back, but you're getting it back in US dollars, which are worth a lot less at the time, if that makes sense to you. So, and again, that goes into, this is my fundamental analysis part of me talking now, with that as to what may cause Treasury rates to go higher and yields to fall if the U.S. economy is heading into a recession sometime this year or next, because common wisdom would dictate that if we're heading into recession, economic growth, then rates should be going down and bonds going up. So I wanted to clarify how that could play out like that. And again, that would be due to a falling dollar or lack of confidence in treasuries. Okay, guys, we're going to wrap it up here. I've covered pretty much everything I wanted to. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed.